Tuesday was a big news day in advance of the CPI print. MBS were down 9 basis points early. Stocks were flat with the global financial market finally out of the holiday weekend mode. U.S. bond trading hasn't found any new inspiration for better or worse. Trading was almost perfectly flat in Asia and generally flat in Europe, where modest gains and losses canceled each other out at the start of the U.S. trading. A few Fed speakers are scheduled in the PM hours, and New York Fed's William is out with some comments early in the morning where he said the basic same old things over and over again. Inflation still way above 2% goal, seeing it coming down mostly in goods and commodities. One more rate hike is reasonable starting place, but will be driven by the data. We'll look at the data. Small business optimism fell again in March, according to the NFIB. Small business owners are hunkering down for a recession. Good call. There's one coming. And are generally dour about the future sales and earnings. Prices are still elevated, but looks like things continue to work backwards towards historical averages. Rate lock volume increased 43% in March, according to Black Knight. Purchase volumes rose 44%, which is well above the normal spring selling season bump of 30%. CarMax reported that 17% of monthly car payments are now over $1,000 a month, which is a lot. That's up from 6% 2 years ago, so almost a 3x increase in $1,000 a month car payments. That is so much money. Tomorrow's CPI report is going to be hugely important. The Fed is going to hang their hat on this data when they meet the first week of March. Market is expecting a sharp fall from 6% to 5.2%, with core to increase from 5.5 to 5.6. My prediction is volatility. I don't think this stuff is going to add up right, and I think it's going to be worse. And we need another rate cut, and that's what we need to do. Wednesday morning brings the most consequential economic data of the next several weeks, I'd say months, CPI. Bond yields spent today moving back towards the middle of their recent range, perhaps to be in a more nimble position to digest the inflation data. The report easily has the power to challenge either side of that range, but it would only use that power if it comes in far enough above or below forecast. For the record, the line item that matters most is the core month-over-month CPI, but some market participants will dig deeper into that number to track core services prices, which are currently taking all the blame for inflation's persistence. My prediction? Pain. 5.5 ended up at 100.81, which was up 6 basis points. Stocks were pretty much flat, as was the 10-year Treasury. So at 100.81, that is putting us right up here in the upward bounds of that range, which is the flat, thick red line, and the blue line, which is the 200-day moving average. So we're right in the middle of that range. For it to move either direction, I don't see us getting any super great low inflation numbers coming, so be ready for that tomorrow. Net production income from independent mortgage bankers fell to a $301 loss on all originations in 2022. So on average, every loan you wrote lost your company money. Yay! The Federal Home Loan Bank System reported that a large decline of about 88% in its debt issuance in the last week of March, compared to $304 billion issued 2 weeks earlier. This decline indicates deposits are being withdrawn from banks. The fewer deposits are being withdrawn by banks. So banking system is getting normalized a little bit. I also got a new post from our sponsor at wellthatmakesense.com. This is from the great book by Jocko Willink, Discipline Equals Freedom. So this is all about fighting weak emotions with the power of logic, and fight the weakness of logic with the power of emotion. So this is how you keep yourself from feeling fear and getting things done.